David, I could maybe just make a comment. I'm sitting looking into the pattern you showed. This is a very programmable.
I was going to talk about it too, yes.
But then I say, well, how are you going to define it? Well, visually, I pick them up after having taken a class so many times. I pick the things that jump at me from the chart. But how do I program it? Obviously, you have to program that the previous important law has to be programmed. Well, how far back will it look? Will it look back 2 months, 3 months, 5 months, 6 months? Question mark, right? Mm-hmm. Also, the second bar has to be shorter than the first bar. Is it supposed to be 1/4 of the first bar, 1/3 of the first bar? Don't know. Then there should be another bar. Like all these things that visually just leap at you from the chart. But when you start thinking of programming them in some kind of strict manner, you realize that they're hard questions which you really cannot answer, or I cannot answer. Mm-hmm. If I say, well, the shorter bar with high volume should be about 1/3 of the previous bar's height. Well, what is not 1/3?
You can't make
1/2, right? Then I'm blocked. Yeah.
Or even if the volume here had been greater than here, that would have even been more bullish, because there would have been a tremendous effort to break the market, and yet all that volume didn't produce. It holds.
As I'm asking myself, how can I program? How can I have some smart friend program it? I say to myself, no amount of programming is going to be as good as just flipping through these charts.
Carrie and I have worked together and tried to develop a scan to identify markets, maybe not in this exact setup with the narrow range underneath the line of support, but just to run a scan that would identify those stocks at the end of the day that have gone under a level of support. So I could at least be attuned to which ones. Because as we all know, we don't see everything. We don't see the charts on all these markets. And some of the things that we did, we'll rule out certain parameters. Number one, we want to look, now this will be with stocks and not with futures, but a stock that's, say, under $95, above $5, has 50-day average volume of 200,000 shares a day. Just for beginners. To delete the dollar stocks that are in spring position that just aren't going to go anywhere. And that we didn't want to deal with the $200 stocks or the $150 stocks. And then maybe how many stocks have had a downturn in their 10-day moving average while their 20-day moving average is still pointed up. You see? Now, I don't know what the averages would be on this chart. It would be something to work with. But we came up with rather large lists, which is too unwieldy. So we did some tweaking on it and came up with better parameters. But along those lines is a way to identify markets in a potential spring position. And much of what we're going to be talking about, or I'm going to be talking about and showing you, is the advantage that recognizing this situation, not just necessarily with narrow ranges. I'll show you some others that are equally powerful. My method here is trying to first, yesterday, give a little bit of insight into how to read, or at least how I read daily or any bar chart. How I look at the range and the position of the close and so on. I can't do that for 5 days or 4 days. So now I usually talk about trend lines and channels because that's an integral part of what I do. My best way of determining if a market is overbought or oversold, not my best way, my preferred way, is to look at where we are in a channel. And so we have here a chart of U.S. Steel. And you see, of course, that we're in the trading range, which I've defined. I've drawn the resistance lines and the support lines, resistance line A and B, support line C, resistance D. You see instantly here at point number 1, what we've already discussed, a little spring. The market went underneath the line of support and did not follow through. When it went underneath the line of the support, there was no serious selling pressure. Now, I'm not saying that this would necessarily have been a spring that I would have been that attracted to, but that doesn't matter. It turned out that it worked. Where I would have become attracted to this spring, since we're looking at it, if you notice 3 days after the spring, the market had a fairly narrow range day, but it closed on the low. And that day was testing this spring. And you notice that the next day, it had no downward follow-through whatsoever and gapped up a little bit. And that would have suggested to me that the test of the spring was complete and that the market would indeed rally. The definition of an uptrend is higher highs and higher lows, right? We all know that. Now I'm looking at this section from day 1 to day 17. And forgetting the channel that I've drawn now, if you look at day 2, day 4, day 7, and day 10, and day 15, what do they all have in common? They all went down. The market went down on every one of those days. What happened on the next day? Was there any follow-through selling? None whatsoever. After day 2, the market gapped up. After day 4, the market gapped up. After day 10, it didn't gap up, but it turned right away up. After day 15, it gapped up. After each one of these days, we never traded underneath that day's low in the context of the trend from day 1 to day 17. So this is a trick. This is a way to get into a market. Forget about the spring. Maybe it never had a spring. If you had wanted to buy this double bottom or whatever you call it, and you missed it, you could have gotten in after it failed to follow through on day 10. And when it immediately rallied away, put your stop there. It's just another way to enter a market that you might not have been able to catch. Now, why did the market stop at point 17? Look at the texture of the rally. It's having difficulty. It's not moving with any ease like it did at 10 or like it did at 2, even though it closed poorly at 2. So we're coming to the top of the channel. And now we get above the top of the channel at 17, and the market reverses down. Why is it that the market is failing here in addition, besides the channel? Previous resistance. Why? Because the people who bought the highs at A and B are thanking the Lord for the opportunity to get their money back. They're liquidating those longs. The people who were smart enough to go long here are now taking profits because this is a previous resistance level. And the smart shorts who see this possibility are going short. And the market is going to have to do what? Absorb all of this selling before it can go higher. And that may not happen in one day. It can be a process. After this absorption is completed, and you really don't know it's completed, you have an idea it is at point number 27, where you come after 26, there was a narrow range attempt to go down and it closed back near the high, and at bar 27 it tries to go lower and reverses up and looks like it's ready to go. You don't know. If you want to wait for another day, you can. But then the market starts a new angle of advance, where I've connected the low of 27 and the low of 36 with a parallel across the high of 30. I'm constantly readjusting the channels. I know this is charting 101, but it pays to draw the channels. And from there, the market continues up, begins to struggle at the top of the channel, backs off, and then on the top day, when we hit $77.77, there's a pretty nasty downward reversal. In fact, that is the largest down day. That is a day where it closed lower. So the largest intraday sell-off of any day since we turned up from point number 1. I pay attention to those things. I look back across charts to see how does today's price range on this down day compare to any other day. If it's larger than X number of days, it catches my eye. I think it's more significant. If it's at the top of the channel, then that makes it even more interesting. But we also look at the bigger context. If you'll look at the next chart, we're also at 77.77 at the top of a channel drawn from on the monthly chart going back to the '03 low, the 2003 low. You see? So this overbought condition on the daily chart becomes much more significant when we incorporate the weekly and the monthly chart. And that reversal action becomes more significant on the daily chart. Now I have this plotted through December 22nd when I prepared this presentation. And you see that in the month of December 2006, the market has rallied above the top of a resistance line and turned down, suggesting a possible upthrust, suggesting that if one is long U.S. steel, one might want not to be long anymore. You might not necessarily want to be short, but you certainly don't want to be long. I find that so many people who trade stocks, and this is sort of a digression, but so many people who trade stocks, number one, don't use stops. Because I own it, right? I can give it to my great-grandchildren. Well, they might be owning some very worthless paper. And in addition, they don't know how to take profits. They don't know how to get out of a market and decide, you know, I've made some good money on this trip. But right here, it certainly looks like U.S. Steel, and I don't know what it's done since then. I don't remember it. I would imagine it's gone down. All right, now, I've developed or drawn this little diagram. It's called the dynamics of trading ranges. I really call it where to find trades. WTFT, where to find trades. As I said to you the other day, markets are mostly in trading ranges. Finding trades is like finding fish. I like to fish in freshwater lakes and ponds. You get out in a little John boat, it's a little flat bottom boat, and you don't fish in the middle of the lake. You might run into something, you might snag something in the middle of the lake, but the fish are primarily around the edges of the lake. They're in the little hollows, they're on the drop-offs, they're on the points, they're around the sunken logs, and so on. So it turns out that around the edges of the trading range is where I look for trades. I mean, we've already been looking at springs, where a market goes underneath the trading range and reverses upward. But sometimes the market does not turn up. Instead, it breaks down. I wrote the word or. Sometimes the spring action fails, and it reverses and goes down. It's not uncommon for the market to, at some point, rally back and test that breakdown before it goes lower. Conversely, when markets come up to the top of a trading range and fails to break out, we get what's known as an upthrust. So I can find upthrusts and I can find springs. In addition, when a market comes up to the top of a trading range and doesn't reverse down and stays there and churns, that's that absorption that I spoke of. And then we go higher, and sometime we may back up and test that breakout before we continue higher. You can make a living trading nothing but springs and upthrusts. Finding those two positions. When markets fail to follow through, now I don't mean to just carte blanche shut your eyes and go short. We don't want to stand in front of freight trains and just go short because it just made a new high and stumbled. Nor do we want to necessarily go long just because it's hesitating. We want to evaluate the situation. We want to look at the individual daily price bars and the volume. You see? But just these two little tricks, if you do it for a year, and say, I'm only going to trade springs and upthrusts. And if you don't want to go short, just do springs. Just hope it's still a bull market. Because springs don't work very well in a bear market. In a bear market or in a downtrend, springs often fail. In an uptrend, upthrusts usually fail. I have tire marks all over my back from going short upthrusts, potential upthrusts in the S&P, thinking, aha, this is an upthrust, because it failed to follow through. And it hesitates, and then it goes on up again. In an uptrend, those upthrusts, they don't work too well. Because why? The underlying trend is always the most important piece of information. All right, we'll stop and then come back in just a few minutes.